I think that's one of the things we forget. We have to go through some volatility. Corrections are normal. We're going through that right now. I think the drivers are probably being misinterpreted a little bit in terms of what the biggest driver is. I think what's happening right now is we got through NAFTA 2.0 and made an assumption we would immediately turn to China and start negotiating that. And that's not happening. As a matter of fact, the opposite of that's happening. We're escalating with China, and that is really going to show up in earnings conference calls.
You've got two really big items there. You've got the potential for a real economic war with the #2 economy in the world and rising interest rates. You say, Nancy, that the market is recalibrating right now. How are you recalibrating your holdings?
Yeah, well, I see some really attractive valuations that we're taking a look at. We've been adding to some of the consumer discretionary names,
like
Amazon, so Home Depot and McDonald's. Those are both stocks that are negatively correlated to rising energy prices. So that's positive for the consumer. You kind of would think the opposite, but in fact, that's
and
not
McDonald's
the case.
Gets a nice upgrade today.
Yeah,
one of the few stocks that's higher.
Yeah. And they raised the dividend, and they just are very consistent about it, as is Home Depot. So we're finding places to go, but we're cautious. I mean, this earnings season's going to be tricky.
Art, I kind of jumped in on you there in my own enthusiasm. How, if at all, are you recalibrating what you're advising or doing?
Well, interestingly, we think that one of the most dangerous things that's happening right now is you're seeing this move to defensive. So over the last week or so, you've seen the REITs and the utilities and the staples actually catch a bid. In a rising interest rate environment, I think that's the wrong thing to do. I think if you want to get defensive, you want to move to cash. I think getting into those, even at the valuations we're at now, is getting ahead of yourself. And those are going to reverse quite quickly when you don't have that natural flow out of markets. That's a dangerous part of the trade. I think where we see the most value currently, I think, is in a combination of healthcare, for sure, energy, and we certainly think you can start thinking about technology, which is probably the worst performing group we've seen over the last month.
But what is the market, if anything, telling us, Nancy, about the economy? And we're hearing all sorts of, the economy is very strong, but you take a look at what's under the hood in the markets. We already saw healthcare, the best performing sector in the third quarter. We see FANG stocks already in correction territory. We saw the semiconductors, a highly cyclical area of the markets, in correction territory. The average small cap stock, according to Bespoke, is down 20%.
Right.
These are all telling me that growth is really slowing.
I mean, I think this is what we're all trying to figure out, because you've got a Fed that's pushing forward with to fight inflation, the elusive inflation. At least it was elusive for Janet Yellen. And then you've got a market that is growing, but we're not sure how fast and what are the inputs. The price inputs are going to be an impact, and then a strong dollar, which is going to hurt the multinationals. So what we're trying to figure out on a company by company basis is who has the growth, and we are overweight in old tech, healthcare, and some of the industrials have done quite well, like Boeing, and we see some of that continuing.
Art, you listed out in your notes here some of the areas of concern, a trade cold war, the concerns over slowing growth in China, inflation and oil prices, a spiking 10-year yield, strong U.S. dollar, emerging market weakness. Given all of those factors, how can you be bullish on the market?
That's a great question. So of all those things you just mentioned, I think trade and trade wars and how big and how long that draws out is the biggest concern we have. Now, I think everything else, to a certain extent, is going to be transitory, for sure. The dollar will not continue to be strong forever when we're not the only central bank that is normalizing. When the ECB and the Bank of Japan start to normalize, first quarter of next year, fourth quarter of this year, we're going to see some less strength. When we stop acting so tough on trade, we're really in the sausage-making part of this trade right now. It feels like...
You mean when, not if?
When. And now, I don't know that happens in 2018, but when we negotiate. We don't want to be in a long, drawn-out, mutually destructive trade war, but we also want to act tough and get China to change some behavior. But right now, watching that happen is like trying to learn how to parallel park in a demolition derby. It's just not fun, and that's causing anxiety in the marketplace.
So final question to both of you. Earnings are going to start next week, basically. What are you looking for? And I guess my question is, what's more important, the rearward-looking numbers or what these companies say prospectively?
I mean, it's the perspective for sure. And I do think...
And what will you want to hear?
I want to hear that the top line is still growing, and they expect to see the top line growing. I am less concerned about earnings in the near short term than I am about top line growth. So that's what I'm going to be paying attention to.
Art?
I think Nancy's right. I think the two things I'd be the most concerned about is, A, how much you talk about the strong dollar and input cost and how much that's going to hurt and bring down your guidance going forward. I think the second thing, and this is as important as anything, this is going to be the first quarter in the cycle where we're coming in, sitting on support versus bumping up against resistance. For the last 2 quarters, last 3 quarters, entering the earnings reporting season, we were actually inflated. So we're actually coming in at a much lower level.
Yeah,
I think stocks look a whole lot reasonably, a lot more reasonably priced. I think to a certain extent, some of that news we're concerned about will be priced in by the time we hear reports.